Here's a reality check that might make your wallet cringe. Inflation just delivered its biggest punch in 8 months. And the worst part? Experts are warning this is just the beginning of a much steeper climb. August 2025's inflation reality. The numbers don't lie. As consumers wandered through shoe stores in Los Angeles on August 28th, they were unknowingly witnessing the effects of an economic shift that would soon hit headlines nationwide. A latest consumer price index data, released by the Bureau of Labor Statistics this Thursday, revealed that inflation surged to 2.9% annually in August, a significant jump from July's 2.7% and the sharpest increase we've seen since January. But here's where it gets controversial. This isn't just a natural economic fluctuation. According to Mark Zandi, Moody's chief economist, inflation is uncomfortably high and it's accelerating. His prediction? Brace yourself for even steeper increases over the next 6 to 12 months. The tariff debate. Are trade policies fueling your grocery bills? Here's what most people don't realize about the current inflation surge. It's largely driven by what economists call reinflation in consumer goods. Sarah House, senior economist at Wells Fargo Economics, points to a startling trend. Core commodity prices, excluding food and energy, climbed 1.5% year-over-year in August, marking the fastest annual pace since May 2023. To put this in perspective, excluding the pandemic chaos, we haven't witnessed core commodities rising this rapidly since 2012, and this is the part most people miss. The primary culprit appears to be President Trump's aggressive tariff policies. Think about it this way. When U.S. companies import goods from overseas, they're now paying substantially higher import duties. These aren't just numbers on a government spreadsheet. They're costs that inevitably trickle down to consumers like you and me. The process takes months as businesses try various strategies to absorb the impact, but eventually those extra taxes show up in your shopping cart. The fact that we're seeing some of the largest tariffs since the 1940s, I think, is certainly a part of the pickup in goods prices, House explained. Translation. We're experiencing trade policy consequences at a scale not seen in generations. The tariff impact has been most visible in household furnishings, appliances, clothing, and recreational goods. Take apparel as a prime example. While clothing prices have only risen a modest 0.2% over the past year, their inflation rate has been climbing aggressively for 3 consecutive months, jumping from a low of negative 0.9% in May. Zandi puts it bluntly, tariffs are all over the apparel prices. They've risen quite strongly the last few months. This makes sense when you consider that a significant portion of clothing imported to the U.S. originates from Asian nations, now facing considerably higher tariff rates. Interestingly, Trump utilized the International Emergency Economic Powers Act to impose many of these sweeping tariffs. The Supreme Court will examine the legality of this approach during oral arguments in November. But here's the kicker. Even if the administration loses in court, economists suggest there are alternative pathways to maintain many of these tariffs. Grocery store sticker shock. When your food budget takes a hit, physical goods aren't operating in isolation when it comes to driving inflation higher. Grocery prices jumped 2.7% in August compared to the same month last year, up from July's 2.2% and representing the fastest annual pace since August 2023. Tariffs may be influencing certain food categories as well. Coffee, much of which comes from Brazil and Vietnam, both facing high tariff rates, along with fruits and vegetables imported from Mexico, are feeling the pressure. But tariffs aren't the only villain in this story. Beef has been causing genuine sticker shock for consumers at meat counters nationwide, according to a recent Wells Fargo Agri-Food Institute report. The culprit? Short supply meeting steady demand. A classic economics textbook scenario playing out in real grocery aisles. Gargi Chaudhary, BlackRock's chief investment and portfolio strategist for the Americas, noted Thursday that fruits and vegetables, which climbed the most since January 2020, and meats, poultry, fish, and eggs were the food products where prices rose the most. She emphasized that many of these food products face tariff impacts since the U.S. operates as a net food importer. Services inflation, the stubborn problem nobody's talking about. Meanwhile, there's another concerning trend that deserves attention. Services inflation appears to have hit a wall in terms of improvement. This means services won't provide much relief against rising goods inflation, according to House. It's no longer slowing, is the near-term issue, House explained. We're going to be stuck here for a few months at least, we think. Consider electricity prices, which have surged more than 6% since August 2024. Zandi attributes this largely to robust demand created by the explosive growth of data centers, which consume massive amounts of electricity. So essentially, our digital transformation is directly impacting our utility bills. Travel costs have also accelerated. Airline fares increased almost 6% from July to August, compared to 4% the previous month, while hotel and motel lodging rose nearly 3%. House suggests this pickup stems from renewed consumer demand. During the first half of the year, consumers worried about the economy and federal job cuts pulled back on travel purchases as a precautionary measure. Now, they're returning to the market, driving prices higher. The Federal Reserve's impossible choice. Here's where the situation becomes genuinely complex. There are some downward inflationary pressures at work. The labor market has cooled significantly, reducing workers' bargaining power and putting downward pressure on wage growth. This theoretically gives businesses less justification for raising consumer prices if their labor costs are climbing rapidly. The Federal Reserve faces what Zandi calls an impossible situation at next week's policy meeting. They're expected to cut interest rates to support the struggling job market, but this approach risks keeping inflation elevated. They have no good choices here, Zandi admitted. The best course is to cut rates to keep the economy from falling apart, but risks inflation being more entrenched. And this is the part most people miss. We're witnessing a real-time example of economic policy trade-offs where every decision carries significant consequences. The Fed must choose between supporting employment and controlling inflation, and there's no perfect solution. The big question everyone should be asking. So here's what I want to know. Are we witnessing the inevitable consequences of aggressive trade policies, or is this simply a temporary adjustment period that will stabilize once markets adapt? More importantly, how long are American families expected to absorb these increased costs before policymakers acknowledge that their economic strategies might need recalibration? What's your take? Do you think the current tariff approach is worth the inflationary cost? Or should we be exploring alternative trade strategies that don't put such direct pressure on consumer wallets? Have you noticed these price increases in your own shopping experiences? And if so, which categories have hit your budget the hardest? Share your thoughts, and let's get a real discussion going about who's really paying the price for these economic policies.